webinar. This webinar is the second webinar in the AFSA series, which are entitled The Future in the Making. The webinars discuss subjects of importance for international arbitration in general, and in particular for AFSA, in AFSA's work and in the implementation of its newly adopted international rules. We're delighted this morning to feature a discussion on third-party funding in international arbitration using AFSA's rules. Pinsent Masons, a founder member of AFSA and a firm, as you will know, with an international footprint and a global leader in international arbitration, will this morning host a discussion with speakers from Augusta, the largest third-party litigation funder in the United Kingdom. Our moderator is Tete Mokela, and without further ado, I would ask her to introduce the discussion. Thank you.
Thank you, Advocate Cooper, and thank you, AFSA, again for collaborating with Pinsent Masons on this morning's webinar. Good morning, everyone, and welcome again. My name is Tete Mokele, as Advocate Cooper has graciously introduced me. I'm the moderator for this morning's session. I'm a senior associate in the Construction Advisory and Disputes team in the Johannesburg office. Before we kickstart, just some general housekeeping. There is a question and answer chat function, which you should be able to see at the bottom of your screen. Please feel free to post any comments and questions in that chat, and we'll be working through them as the presentations progress. Our presenters this morning are Angela Lawrence, my colleague in the Construction Advisory and Disputes team here in Johannesburg, and she will be taking us through the third-party funding rule introduced by the AFSA rules, and amongst other things, how this rule is likely to be applied locally and the benefits to parties and lawyers alike in adopting the third-party funding model. Angela's presentation will be followed by Augusta, a funding facility firm which provides funding to manage the cost and risk of conducting and resolving disputes by litigation, arbitration, and adjudication, and who will be taking us through the various funding models that they offer, as well as providing a practical insight of how third-party funding agreements work. We, of course, wouldn't be having this discussion this morning had it not been for the coming effect of AFSA's international arbitration rules, which came into effect on the 1st of June, 2021. The rules follow the enactment of the South African International Arbitration Act of 2017 and are intended to improve and facilitate AFSA's management of international disputes and make their resolution easier. The rules represent a significant moment in the development of Southern Africa and the SADC region as a whole as an independent hub for conducting international arbitrations administered by AFSA in a way which is aligned to international standards and norms. One of the groundbreaking features offered by the rules is this new third-party funding model that is expressly provided for. And without further ado, I'll hand over to Angela, who will take us through the rule in more detail.
Thanks, Tete, and thank you to AFSA and Augusta for participating with us today. While I'll leave the intricacies of how exactly third-party funders become involved in what they do, I'll leave that to Augusta, but what I will be dealing with is the third-party funding in our market and why it's becoming more acceptable and necessary. So if you'll give me a moment, I just have a PowerPoint presentation to share. Tete, if you can let me know if you can see that.
We can see it, Ange.
Super. So first, let us deal with the legal framework in which third-party funding arises as a starting point. Where does it fit in? So previously, the notion of others who are not parties to litigation becoming involved from a funding perspective was dealt with in the context of contingency fee arrangements. These sorts of arrangements were, however, between attorneys and clients only and involved the attorney taking on the risk of deferring payment of fees and or disbursements until the outcome of a dispute is realized, with the possibility of a success fee built into it. Even then, contingency fee arrangements sought to regulate through legislation in South Africa and registration of such arrangements with the Law Society, now the Legal Practice Council, the payment of too high a proportion of those success fees to attorneys for their investment of time on behalf of clients who could not otherwise afford to bring or defend claims with the assistance of attorneys to begin with. That is not to say that parties have not ever been assisted from a funding perspective by third parties outside of the attorney and client relationship in the past. Third party funding is also in fact permitted under South African law, thanks to case law precedent, and are not considered automatically to be against public policy. But it is currently not regulated by legislation and has even been discouraged by South African courts in some instances because of the potential advantage that third-party funders may take of vulnerable litigants. Other concerns of third-party funding have included, for example, that the involvement of third-party funders would lead to an abusive process. Alternatively, it would enable frivolous or vexatious litigants to the benefit of the funder and to the prejudice of both the funded and the opposing party. Other concerns involve there is a potential conflict of interest for third-party funders, particularly if those funders have any connection with the law firm representing the funded party or the arbitrator presiding over the matter. And thirdly, the involvement of a third-party funder in the first place might indicate that the funded party's ability to self-finance its own litigation is in doubt, which in turn places questions on the potential enforceability of an adverse award against that party, as well as that funded party's ability to fit the bill if a cost order is awarded against it. And secondly, if the opposing party ought to seek security for costs, and from whom, the third-party funder or the funded party. So the market for it in South Africa and the SADC region generally has therefore historically been informal and underutilized because of these sorts of concerns. But it can no longer be ignored when measured against the greater injustice, which is not having access to justice because of financial constraints. So since 2018 or so, organizations such as Chambers and Partners and Leaders Rankings have also begun ranking litigation funding firms, at least in America as well as the UK. So its popularity and acceptability is becoming more commonplace. So this is where the new AFSA rules come in, the international rules. Although not legislation, but promulgated in terms of the International Arbitration Act, the rules seek to answer the question of whether third-party funding has a place in the current arbitral market in South Africa and the wider African market who adopt the AFSA rules, at least insofar as international arbitrations are concerned. More specifically, Article 27 of the new AFSA rules now provides expressly for the recognition of third-party funding arrangements in respect of material or financial support for all or parts of the costs of an international arbitration. So who is considered a funder? It can either be a natural or a legal person who is not party to the arbitration and is not a party representative like an attorney, but who enters into an arrangement either with a party, an affiliate of that party, or the party representative in order to provide material or financial support for all or part of the cost of the arbitration, where such support is provided through donations or a grant, or in the exchange for remuneration or reimbursement, wholly or partially dependent on the outcome of the arbitration itself. So this Article 27 requires further that a funded party be transparent and must advise all other parties, the arbitral tribunal, as well as the Secretariat of AFSA, of the existence of a funding arrangement and the identity of a third-party funder, as well as any changes to that information. In other words, it's not mandatory to disclose the agreement itself, only that one exists and who the funder is. Some have noted that AFSA's approach with Article 27 may be fairly reserved because it requires that a minimal amount of information is disclosed. Comparatively, the International Chamber of Commerce's 2021 arbitration rules require a similar level of disclosure to the Secretariat, the Arbitral Tribunal, and other parties of only the existence and identity of a third party having an economic interest in the outcome of an arbitration. And this is quite obviously similar to the current AFSA rule. But the Hong Kong International Arbitration Centre's administered arbitration rules provide for arbitral tribunals to go just a little bit further, and that they can take third-party funding arrangements into account when determining an award in respect of costs. And similarly, the Madrid International Arbitration Centre goes even a little further to require a party to disclose the existence of a third-party funding arrangement, the identity of the funder, and also further information about the funder and the arrangement that the arbitral tribunal considers appropriate, subject to the rules of non-disclosure, confidentiality, and privilege. So on the whole, it appears that AFSA's Article 27 aligns for the most part with the international practice on the issue, but it is not as open as some. So let us look at what guidance we can get on maintaining some checks and balances on third-party arrangements in light of the concerns that have been raised about third-party arrangements in the past. So as I've said, we can get some guidance from case law. It has been dealt with in case law, and the High Court has stated in South Africa that factors that can determine whether a third-party funding arrangement is fair and reasonable include that the arrangement is necessary to provide meaningful access to justice. The agreement between the funder and the funded is fair in protecting the interests of the funded. The arrangement must not overcompensate the funders for assuming the financial risks of the litigation, and the arrangement must not interfere with the duty of lawyers to act in the best interests of their clients or the client's rights to exercise control over the litigation. So there's also a check and balance on the integrity of these arrangements by the courts, where questions are raised as to whether or not they are fair and reasonable. That leaves the other burning question that most people want to know about is who is responsible for costs if the funded party loses? And the answer to that is it depends. One would expect firstly that any sensible funded party would deal with this aspect in the funding arrangement so as to have transparency on its own financial exposure upfront. But insofar as it's not a requirement in the AFSA rules to physically disclose the third-party arrangement to opposing parties, only that one exists and that who the funder is, this might make an opposing party a little bit nervous. So the question of if a third-party funder could be joined so as to be held responsible for costs has accordingly come up in the courts as well, which have held that third-party funders could be held responsible for costs. But the predominant consideration to determine is if the funder is a pure funder or not. And this requires an investigation into the level of involvement of the third-party funder and how much control they have on the proceedings. In other words, has the funder been driving the litigation or has the funded been driving the litigation? What does the funder stand to benefit from a favorable award? And can the conduct of the funder in those circumstances be considered fraudulent or in bad faith? So there's no clear answer, and this will have to be tested by the South African courts again in due course. But for SADC countries adopting AFSA rules and South Africa as a seat of arbitration, they will be able to have the benefit of this case law guidance in due course. So what is the context in which third-party funding could become attractive in South Africa and SADC going forward? Although South Africa and SADC is the most advanced, well, South Africa actually is the most advanced litigation funding market in Africa, it's still in its infancy compared to the global markets. But one only has to look at the status of the current construction and infrastructure industry in South Africa and SADC, thanks partly to a decade of economic downturn, which has been accelerated in the past 18 months by COVID-19. And the phrase cash is king is fundamental. Contractors and subcontractors need cash flow, but are often subject to lengthy lag times in receiving the proceeds of claims brought against employers for things like delays and disruption on a project in adjudication and or arbitration. So adjudications these days are also treated almost like mini arbitrations. So the costs involved for what are meant to be expeditious and cheaper dispute resolution mechanisms often come up to as much as arbitrations themselves. So a further timing related risk is that subcontractors to principal contractors or major infrastructure projects are often subjected to onerous pay when paid type terms, where they have to wait for the outcome of upstream claims brought against the owner or employer by the principal contractor before its claims are determined and paid downstream. So other factors that might arise are contractors and subcontractors are sometimes inclined to settle claims early, often to the detriment, their own detriment, compared to if they had pursued the claims to their fruition, simply so that they can get the cash. But that might result in them underclaiming. And similarly, underclaims arise because of not having enough resources or time for these contractors to devote to putting claims together properly. And had they had other resources and not had to focus on chasing the cash, they may have been able to bring better claims and more structured claims. So all of the above takes cash away from the contractor and the subcontractor's operations, which could otherwise drive progress of projects. And it also begs the question that if third-party funding had been available or considered more acceptable to the likes of the Group 5s, the Basil Reeds, the ESOL Construction, Murray & Roberts, Robex, that these sorts of companies could have avoided potentially their ultimate demise through restructuring, business rescue, and or litigation. And if a third-party funder were involved to take on that risk off the contractor or subcontractor's books, and an appropriate trade-off can be determined for that third-party funder taking on that risk, then by all means, why not involve them? Suffice it to say for now that third-party funding, certainly from our perspective, opens up a lot of avenues for litigation where more restrictive avenues were thought to exist. So I for one, am excited to see where this goes. And on that note, I'll hand back to Mete.
Thank you, Angela. And I think it's a very important point that you touch on there about, you know, had this rule been in existence at the time that your Murray & Roberts and your Group 5s were facing some of the challenges that they were facing, if we wouldn't be in a different position today, if they couldn't have been assisted. And the benefit is not only for large corporations like that, but like you mentioned, your subcontractors and your smaller contractors on projects aren't always in a position, even though they have very strong merits to their claims, to prosecute their claims, because claims are often prolonged and they go on for an extended time. And like you said, they just don't have the cash flow. And that's where a model like the one that's introduced under the AFSA rules will be very beneficial. So yeah, some great points there that you've raised. I see there's a question that's come in. It's from Neil, and he asks, what is the justification for allowing parties to conceal the terms to the third-party funding agreements from the other party? Would you like to answer that?
I would say that is because there is always the underlying principle of pactus and servanda. Everybody has their own right to contract in a manner that suits them. And why should a litigant have to be forced to disclose an agreement that would otherwise be confidential and or privileged because it's the nature of the funding, whether it's whole or in part, might impact on how the opposing party would treat you as a litigant. So it's entirely a commercial relationship between yourself and the third-party funder. It's essentially a return on investment type agreement, and that has to be protected in itself, as well as the rights of the other party. So confidentiality.
I agree entirely. It's absolutely first and foremost a matter of relevance, and the funding of a business or of a claimant more generally, their sources of capital and how they finance their operations is not something that a tribunal or a court would normally order to be disclosed. The existence, we're fully supportive of the existence of the funding and the name of the funder being disclosed for obvious reasons around conflicts and things of that nature. But the substance of the agreement, even beyond the points we just made about kind of relevance and the right to contract, the very terms of the funding agreement, and we'll come to them in a moment, if they were in the hands of the other side, could be used strategically to try and turn the screws on a few different points. For example, our success fee is calculated based on the amount of time that runs, and being able to, as I say, kind of use that strategically to make offers, knowing the consequences of that from a funding perspective, could be hugely damaging to a claimant and hugely damaging to us as well. So there's a real strategic, there's a legal, but there's also a kind of strategic consequence as well for why, if it's going to work, it needs to remain properly confidential.
But more so than being confidential, it might also be privileged as well.
Yeah, there's that's our foremost defence in all of these. Whenever it's ever raised, that's the position.
Okay, I guess then on that note, I'll hand over to you then, Robert and Andrew, on your section of the presentation.
Great. Thank you, Tete, and good morning, everyone. Angela, thank you for that. That was very interesting. I am going to attempt to share my screen now, and hopefully I'll be as expert as Angela, if I can find it. Second. Oops. There you go. Good. Okay, and not quite as expert. Good morning, everyone. At this time, I normally ask everyone in the audience who has used litigation funding before. And typically, you don't get too many hands going up, and I reckon we're not going to get any hands going up today. But it would be very interesting to see who has used it before and who has had positive and possibly even who has had negative experiences with it. But quite simply, it's a process whereby a funder can provide funding to cover a portion of all the costs of conducting a claim in return for a share of the damages if the claim is successful. The costs we cover, typically the legal costs, or although in certain cases it can be costs associated with a company, not necessarily purely focused on the legal aspects, but it covers the cost of lawyers, counsels, independent experts, and many other disbursements, including something that we will go into later, ATE insurance, or after the event insurance, which covers the adverse cost risk that Angela touched on. And perhaps most importantly, funding is non-recourse. If the case wins, we take a very modest, I might be slightly biased there, but a very modest multiple on the money we've deployed, or indeed a share of the damages that we are recovered. But if the case loses, we lose all the capital that we've invested in the case. So effectively, I believe we are a risk management tool to the claimant. Effectively, we're an option, allowing the claimant to decide how much or how little risk they want to take on board while pursuing their claim. And that has always been the case, and it's true today. But what we're also seeing, and I think it's quite interesting, and I do think it's as a result of this dreadful pandemic that we're all going through, we're also seeing particularly corporates, they look to us as a source of liquidity. They now know that even if they have cash on their balance sheet, they can cover their legal costs by using someone else's, namely our cash. So cash is very much king. They want to keep their cash to invest in their business, but they can pursue the legal claim using our capital, and they will still get a fair share of the damages. And I think that's really, really interesting. And I think this has been perhaps the biggest effect that we've seen with over the last 18 months to 2 years. Angela mentioned that one of the concerns of litigation funding is that it may encourage frivolous claims. Well, I'm planning on just giving you a very high-level overview on litigation funding, and then my colleague Andrew will go through our due diligence process and then go through a couple of case studies. And this perhaps is not so surprising, we do follow a very rigorous due diligence process. We don't like to lose a case. And if you look at our statistics, we win probably around 2 out of 3. But if you look at the number of inquiries that we see, we probably only invest in about 2 or 3 of the genuine, or of the general inquiries that we see. If we receive a case from a firm such as Pinsent Masons, who we do a lot of cases with, they will know how we work, they will know what our due diligence process is. So it's very likely, or much more likely, and I rate it probably around 7 or 8 out of 10, that if they show us a case they genuinely believe in, then we're very likely to fund that case. But I suppose the effect is that we will not fund a claim unless we think it has a genuine chance of success and a genuine chance of us recovering the money. And that certainly would not encourage the frivolous claims that some people might argue. So moving on to the next slide. Question we are asked is, what type of claims do we cover? We are able to fund claims of almost any size. There is a proportionality which will affect us stopping or not funding a claim that is too modest in its size. The reason for that, and Andrew will explain in a little bit more detail with the case studies, we will never fund a claim unless the claimant is expected to receive at least 50% of the damages. And on the larger claims, it would be considerably more. But effectively, we are open to funding claims of almost any size. Funding, we fund obviously litigation, we fund arbitration, and we also do adjudications. They have their own issues, I suppose. It tends to be, obviously, as you know, a lot quicker process. But we're very comfortable with funding all types of claims. Another question we get asked is, when will we fund the claim? We are prepared to review cases at any stage of the process. But if you can imagine, we need to be able to see a claim and be comfortable that it has a sufficiently strong legal merits and sufficiently strong recoverability prospects before we can get comfortable with it. But theoretically, we are able to fund a claim at any stage in the dispute resolution process. We also are increasingly seeing certain claimants coming to us with multiple claims. particularly in the construction industry. If a claimant came to us and had, say, half a dozen claims or even less, well, then we would be very happy to look at those claims on a portfolio basis. And the effect of that is that there's cross-collateralization between the individual claims. From our point of view, that makes our risk lower, which will in turn mean that our pricing structure to the claimant is more competitive. So I think it's an interesting development in the litigation financing market, and obviously pricing is all rated according to the actual risk involved. And of course, we will fund individual claims on their own. If we go to the next slide. So effectively, what are the benefits of funding? As I said earlier, companies are able to use someone else's capital. They can reduce their financial exposure to zero. They can actually make their general counsel a cost, rather than a cost center, a profit center, which may, for certain cases, for certain companies, be useful. But they can monetize the claims without, in many cases, any downside of financial risk. The reducing of the legal expenditure frees up cash flow, so they can use it more directly in their core operations or in other investments. And an interesting feature, which again the larger corporates are very much focused on, is the fact that this can take the litigation liability that sits on its balance sheet off balance sheet. So you will see in certain cases companies that are concerned with the valuation, the market valuation of their company, looking to take funding from a third party, because all of a sudden that litigation risk is taken off the balance sheet. Any multiple that the company is trading is multiplied on that reduction, and the value of the company can be increased. Savvy CFOs are very much aware of that potential opportunity of litigation financing. Of course, access to justice is I suppose, the predominant reason for litigation funding over the last 10 years or so. It is something that one always looks at the David and Goliath situation. If a claimant just does not have the capital to pursue the claim, that is substandard, and that is something that litigations can redress. It will also, if you're David and Goliath, the Goliath can drag out the claim for many, many years. So effectively, we will provide a level playing field to the claimant. We get our financing from very large credit funds at the moment, which is effectively, we have a very big balance sheet, big checkbook, so we will level the playing fields. And if we disclose this to the other side, they will be aware of the fact that the war of attrition might not be so successful as it may be ordinarily. I think it's also important for people to understand the process that we follow. And as I mentioned earlier, we see an awful lot of claims. What a claimant doesn't want is a funder to look at a claim and then keep looking for many months. And then at the end of it, turn around and say, this case isn't fundable. we're very conscious of the fact that for a claimant, getting a quick response, a quick and clear response is very important. So we will try very hard to say no, strange enough, to a claim as quickly as possible. And interestingly, the claimants and indeed their lawyers are very grateful for that. Claimants do not want to waste their time and effectively their money pursuing a claim if it's not going to have a significant chance of success. So the fact that we do have a significant, robust due diligence process, which starts with an initial view to see whether it is something that we might possibly fund, is very important. And I think that's probably more important to the claimant, or often more important to the claimant, than the actual cost of the funding. Also, the fact that if the other side is aware that a case is being funded, it's aware that we only fund 2 or 3% of the cases that we get shown. This may well incentivize a settlement at an earlier stage, and we'd like to think a better or a larger settlement for the claimant. That is always difficult to prove, but it's certainly a feature that we have seen with many of the cases that we get involved with. We are conscious that we would be delighted to answer any questions as we go along. So if you do have questions, please ask them, and we'll cover them at the end. But at this stage, Andy, can I pass over to you and you can go through our due diligence process?
No worries. So my name's Andy O'Connor. I was formerly an infrastructure and construction lawyer at Ashurst, and as my accent portrays, operating out or working out of Sydney before I joined Augusta in London. My background and what I do at Augusta is pretty squarely in the construction space. It's where our focus is. Even though we're based in London, a lot of what we do, well, the vast majority of what we do is international. Projects arising out of the Middle East, Africa, Latin America. Very little of what we do is actually, domestic focused. So we're operating globally. And Robert's introduced, I suppose, the theory of funding, which is pretty simple, hopefully, which is that there's a facility to pay for the cost of conducting the case. And if we win, if the case is successful, Augusta receives a success fee. And if the case is lost, we don't receive anything. That premise, I hope, is we can answer any questions that arise from it, but that's the starting point. What I'm going to speak about today is very much focused on the nuts and bolts of how funding works. And I don't have anywhere near enough time to do it all justice, but to summarize, there are 2 key things that matter for a claimant looking or considering funding as an option, whether you approach Augusta or anyone else in the market. Those 2 factors are, what is the process? How do I get a case funded? What do I need to do to get us from point A to B, where the funder is able to make an investment decision so that I can be certain of funding? What's the funder going to look for? The second one is price. It's as simple as that. How much is it going to cost? How is the success fee calculated? And ultimately, based on what I think this claim is worth, what slice of the pie is going to be left for me as the claimant? And that's obviously probably the most important thing, because if that doesn't work, or if that isn't commercially attractive or commercially sensible, then funding isn't going to be something that's taken up. So I would emphasize price and process are key. Dealing first with probably the less entertaining of the 2, which is process. Whether we're funding litigation, arbitration, or adjudication, the 3 things that we need to focus on are all they're always the same. They are, does the claim have strong legal merits? And what's the overall quantum figure that we can expect to get from that? We don't need certainty in these things. We operate, we're a litigation funder. If we needed certainty, we wouldn't have a business, because there'd be no cases to fund, because nothing is certain. How we assess point number 1 around overall prospects of success is very much, we rely very much on the opinion of your legal team. And so to bring all of the strands together in any case, we will ultimately need a written opinion from your legal team that gives their views on the overall prospects of success. And each case is different. So in my practice, where overall prospects depends fairly heavily on matters of, say, technical or expert evidence, then we're going to need to fold in some sense of a view from a consultant or the internal technical team on what exactly happened on a particular project, so that the law firm can take that view and then give an overall view on prospects of success. And I'm going to say something that some of you, I'm glad we're not on screen, you may laugh, but the confidence level or the conclusion that we need that opinion to reach is 60% prospects of success. That is, for better or worse, for as absurd or not, that is the confidence level that our investment committee requires to hear from either your legal team or counsel acting on the matter. We'll also look at enforcement and recovery. So an award on paper for us doesn't constitute success. So if you're successful at final hearing, it is then necessary to enforce that award. And for us, that's a major risk factor when we embark on funding from the outset, because we might be looking at a case where we know very realistically that an award, let alone enforcement and recovery, is probably anywhere between 2, 4, even more years down the track. So understanding the risk of the other side, to put it bluntly, either going into liquidation or taking steps to kind of move their assets to jurisdictions that are difficult to access, is something that we focus on immediately. And point 1 on your screen is something that lawyers are really good at. Legal teams are fantastic at, in their experience and based on their knowledge of the case, of assessing prospects. Where we see a lot of claims are where there hasn't probably been as much thought or analysis applied to what's the financial position of the other side, so that even if we win, how are we actually going to recover cash? And it's only from the cash that Augusta gets paid. So we pay a huge amount of attention on that, and we think we're pretty good at it as well. So we don't expect legal teams to have done this work. That's not their area of expertise. It's very much where we will focus as when a case comes in and we look at the party names. The third limb of our of diligence goes to what we call the economics, the numbers. How much funding is required. And as Robert said, there's no strict minimum or maximum amount of funding that we can make available. We're very lucky in that regard. We will require from your legal team a pretty detailed budget broken down by phase. And the reason we want that is that you can imagine we provision the funding, and we just want certainty for what is an appropriate amount of budget for this case. Now, there's no such thing as certainty in budgets whatsoever, but we do have a pretty robust discussion with the client and the legal team to make sure that the budget is right. And if anything, I'd say 9 times out of 10, that probably means that the original budget that we saw was probably a little lean. You can tell that there's not enough, in our experience, we know, and most clients know as well, that legal budgets tend only to go up. And we just want to have that discussion from the outset to make sure that what we're committing to is the right number, as close as we can get to. And we can vary it along the way, but we'd prefer not to. The budget is important for that reason, but it also ties together the whole arrangement as to whether or not funding makes sense for the client and whether funding makes sense for Augusta. And Robert introduced the term proportionality. What he meant by that is that there needs to be sufficient proportionality between the amount of funding required and the realistic quantum for this to make commercial sense. So even without funding, if you're just funding a case on your own, off your own balance sheet, there's no point spending $1 million to recover $1 million. That doesn't make good commercial sense. When funding is in the mix, we're going to receive our success fee. And I'll come to how that's calculated in a little while, but we're going to receive our success fee. So for this arrangement to be commercially attractive to the client and to make sense, there needs to be sufficient spread, enough buffer in the claim for us to be able to be repaid our success fee and for a very material share of that pie to be left for the claimant. And we know that from our experience, at a minimum, what we want to see is a spread of at least 10 times between the budget and the realistic recovery. So I'll speak in dollars just because of forgive me for currency and sensitivity. I suffer it a lot as an Australian, but if we know that $1 million to recover $10 million, that can work. If it's $5 million to recover $50 million, that can work really well. The greater that spread, the better. Any leaner than 1 to 10, it can work. 1 to 8 is fine. But as you get lower and lower in that spread, once you're kind of spending, say, $1 million to recover $5 million, it just means that the slice of the pie left for the claimant is less. And we don't want, that's not where our business wants to be. We want to be funding claims where at the end of the day, the claimant is very happy with the slice of the pie that they're left with. So for us, it's a kind of, almost like a relationship thing that we don't want to be doing that if we're taking too much. From the claimant, they probably don't want to sign up to it anyway. So that's a factor that we often turn down cases where because you can't change quantum, it is what it is. And in the reality of the world is you can't change legal budgets. They very much are what they are. So proportionality is key. And for that reason, we often turn down cases on that basis, unfortunately, if they're just hitting too low a mark. We also want cases to settle, and we see that tightening that proportionality, if the claimant isn't going to be happy, we can't control the case. We can't control the outcome of a case or tell the client what to do. So from a risk perspective, to facilitate settlement, we want there to be sufficient spread between the realistic recovery so that if an offer comes in, it makes sense for the client to say, yes, I'll take it. If the client says, you know what, I'll crack on and have my day in front of the tribunal, that's a risk for us, and we'd rather avoid that happening. Bobby, can you please skip ahead a slide? Sorry. That's a rough timeline of the overall milestones that we tend to see. Each case is different. It's important for us to get the term sheet agreed as soon as is sensible, as soon as we know what the risk profile of the case is, because there's no point leaving that commercial discussion until right when we've both committed resources and cost to diligencing the case. We want to make sure that everyone's on the same page when it comes to commercial terms as soon as possible. I'm just conscious of time and I want to answer a few questions, but we'll go one slide ahead, Robert, if that's okay. So success fee. This is, we've moved on from process to price. And again, I flagged that I won't do any of these justice in the time that we have, but so how the success fee is calculated is probably the most important part, as I've said. When people tend to think of litigation funding, part of a lot of people's first thought is that the way the success fee will be calculated is a simple percentage of the damages, 30, 40, 50%, whatever you want to call it. That's how the funder will calculate their return. That's very much a legacy perception, if I can describe it in that way. That's how the industry tended to operate when it was in its infancy. And the industry still has a long way to go in improving and becoming more efficient. But that way of calculating the success fee is still an option. And in some cases, it makes a lot of sense, to be honest. But for the majority of our clients, we tend to fund on a different basis, where our success fee isn't just a simple percentage of the damages. It's based on the amount of funds drawn from the facility. So the facility is drawn down each month to pay for invoices that come in. That means that at any point in time, and this is poor English, there's an amount of drawn funds. And it's that amount of drawn funds that is the basis for our success fee. So if the case resolves, we receive drawn funds back plus a multiple of that drawn amount. So for ease of maths, say we provided a facility for $1 million. If $100,000 was drawn down and the case settled, we would receive that $100,000 back, plus a multiple only of that $100,000, not the full facility, because it's way too cumbersome and heavy to calculate in that way. So and the way those figures are calculated is that if it resolved relatively early on, and I'll show you on the screen in a second, using that example, we'd receive the 100,000 back plus a multiple that starts at around 1.5 times or 150%. So we'd receive the 100,000 plus 150. And if you move to the next slide, please, Robert. Here's an example where, call it, depending on your practice and the types of projects that you're looking at, these numbers, the amount claimed and the facility amount maybe too large or far too small, but just bear with me for ease of example. You can see at rows in the table at the bottom, that's the success fee. You know, if the case resolves in months 0 to 6, we receive 150% success fee. If the case resolves in months 7 to 12, we look at the amount of funds drawn at the date of resolution and we'll receive the multiple on drawn funds. And as the case goes longer and longer, that multiple increases over time. There is also, just to say it, then you can see it on the screen and just there's questions about it, there's a multiple of undrawn funds, which is horrendous English, but it's also, that's a cost of capital. That applies to the entire amount of the facility that isn't used when the case is resolved. And it's a fairly modest amount. So if it resolved after, if $100,000 was used of the million, we'd receive, the main metric for the success fee is the 150,000. I'll just flick to the next slide.
Andrew, if I can just remind everyone, of course, if the case loses, we lose all our deployed capital.
Absolutely. If you just go, if you go to the next slide, and this will be where I conclude, we'll just show one example. And you know, if the case resolved after 12 months for $15 million, if we've used 800,000, meaning that there's 1.2 million still left in the facility, that's our uplift. That's how it's calculated. So 175% times the 800,000, leaving a total success fee for us of 1.52 million. And the distribution of you know, and how the claimant's share works in the waterfall is there. I'm not here to say that funding on a single case basis is extremely cheap. It's not. It's an extremely risky business, and we think that we're extremely competitive in it. For any claimant, and you know, we think it's an option they should consider. And when they're making that assessment of our term sheet, where their focus must lie is on the blue slice of the pie. And I'm not, again, saying that this is, not every claimant should take funding for various reasons. But if they look at the blue slice, oftentimes I'll get asked, hang on, you're taking the gray and the blue. And the answer to that is, yeah, the gray is the return of the amount of funds drawn. That's just saying the amount of funds drawn comes back to us. But in any world, if the claimant had paid for the cost of the case themselves, that gray area is just an amount that they'd be out of pocket. So the difference, you know, the counterfactual between taking funding and not taking funding isn't the blue and the gray, it's just the blue. The blue is what the claimant is giving up in return for us agreeing to fund the overall cost of the case, because regardless of whether they take funding, the gray is just the cost that's been incurred in actually getting the case to resolution. I hope that's helpful. We've got eight minutes. I had another example on the other side, but it's kind of just another instance of a different scenario, a different resolution scenario for this case.
Thank you, Andrew. Thank you for that very insightful breakdown. And I think the worked examples that you've presented are very useful. I see quickly before we wrap up, there's two questions that have come up. So I think maybe now would be a good time. The first one is relating to tax implications. Someone has asked, are there any tax implications that have to be considered with third-party funding? And if so, what are the implications?
Who wants to take that? Andrew, shall I?
Yeah, go for it if you'd like to. And then there's a couple of ways you can approach it. So
well, you go ahead, Andrew.
Well, they're probably mostly for us. You know, how we fund is pretty complicated, but obviously this is asked from a claimant's perspective. And the short answer is, to be honest, the tax implications of the overall accounting framework for non-recourse litigation funding is extremely favorable, because your balance sheet, we're not there because we're non-recourse, and we don't need to be recorded as a liability. When it comes to how we are taxed on the way out, it depends on the business if we're successful. But we can just, our success fee can just be treated as an expense of the business in the way that, you know, interest or anything of that nature can be treated for tax purposes. But that's only relevant if we win and we're successful, obviously. I may be missing if there was another aspect to it, but if anyone wants to add to it.
No, I think that's it. So I guess what you're saying is that the risk is probably more to you guys as the funder as opposed to the actual party themselves.
That's right. Yeah, we have kind of, you know, withholding tax issues and things of that nature that we have to overcome. But yeah, for the claimant themselves, it's more a matter of, you know, how do they treat perhaps the success fee from tax purposes.
Okay, and another question, maybe Robert, you can take it. He says, how do third-party funding agreements deal with the possibility of any adverse costs award against the funded party to proceedings? And would these costs be covered by the funder under the third-party funding agreement?
Yes, as Angela said, the third-party funder could ultimately, and it's a grey area, but they could ultimately be responsible for the adverse costs if the claimant were not to cover them themselves. So we have a very strict policy. If we are making a loan to a claimant, we will insist that the adverse cost risk is covered. And the vast majority of times, this involves the claimant purchasing ATE insurance, after the event insurance. That policy will pay out if the case is lost, and it will cover the amount of indemnity that it's been written for. So certainly in some arbitration cases, we feel that there isn't a significant adverse cost exposure, so that would be fine. But if there's in litigation, certainly in the UK, we would insist that the adverse cost exposure is covered by the claimant. We are very familiar with the market. We fund more cases than anyone else in the UK, so we have access to, we have access to the insurers who can provide. I was going to say the most efficient ATE insurance. ATE insurance is not cheap, but it's probably the least. We can get access to the least egregiously priced ATE market. ATE policies in the market. I hope that covers Mark's question.
Yeah, thanks. Thanks, Robert. There's a comment that's come through that says, does the fee conclude at award or when the award is actually paid out? Would I be correct in saying it's when the award is actually paid out, and that's why recoverability is such a big factor?
Yeah, it's spot on. That's when our risk ends.
Yeah. All right.
And that's the right way it should be. You know, we are in this totally aligned with the claimant. If they get an award, we take a piece of that award. So our return only obtained out of any award that is covered, that is obtained.
That is the last of the comments and the questions. And I think now would probably be a good time to just wrap up. Thank you, Robert. Thank you, Andrew. And thank you, Angela, for your presentations. And again, thank you again to AFSA, our gracious hosts, for allowing us this platform this morning. Thank you, everybody.
Thank you.
Pleasure. Thank you all very much.